Welcome back to the Wolf of Property and Casualty. I'm your host, Derek Lasniak. 15 years of experience focused on the middle market, upper middle market, national account space. Today's topic, captives. And for those of you who have painfully made it through all these episodes, you might recall that I did an episode on captives. I'm going to talk about a different captive today. I'm going to talk about the micro captives. The previous episode I did was about group captives. Group captives are becoming commonplace as a risk transfer mechanism, primarily used for casualty lines that are predictable. Work comp, auto, GL, and they are robust systems that feel just like normal insurance that allow you to join other like-minded companies and actually have more control based on your experience individually as an organization and losses for your premium that gets paid in. And those captives, I think, are here to stay. Even though the market's kind of softening right now, I think that they have finally found a footing where they are an option, whether the rates are up or the rates are down. But the captive I want to talk about today is a little bit more of a unique and a different style of captive, but a lot of the concepts are the same. And again, these are called A&B micro captives. They're named after the IRS tax code rule plan 831/B, where they allow for the tax preferred treatment of premiums. And I'll get into that a little bit more. I'm not an accountant, but I want to talk about how they are similar to the captives that many people already are aware of. In a traditional captive, you take your work comp, your auto, and your GL traditionally, and working with your broker or and their representative, you're going to look for a captive that's in place that's essentially a group of companies like you, similar size structure and risk tolerance, that have formed and own their own insurance company. You buy a piece of stock, and now it's Contractors Across the World LLC, and it's made up of 80 contractors, and we all have a stock percentage ownership, and we run Contractors Owners LLC insurance company together. And we're all putting these three coverages, we're taking them out of our Travelers Liberty, CNA relationship, and we're putting it into the captive. And we have a fronting carrier, and that fronting carrier makes us so that we have insurance. And again, I did a whole episode on this. Well, a micro captive is similar, except you actually own your own insurance company. The client is starting their own insurance company. And that insurance company, in order to qualify for the rules of insurance premiums, then gets put into a pool of other companies who also own their insurance company. And that pool shares in the risk. Because again, for any kind of insurance, you have to have a calculable, actuarial based risk transfer of premium in exchange for risk in order for the premiums to be deductible. So the way that a 831B is going to share that risk is by taking every individual company's own insurance company and putting that in a pool, as opposed to putting certain lines of coverage and then jointly owning. Subtle difference, but it is a difference. And because of that, because you own your own insurance company, 831Bs don't serve as broad of an audience as traditional group captives. They differ in a couple different ways. The first is, when you own your own insurance company, primarily going to be registered in either Delaware or Utah, there's a lot of paperwork and a lot of stuff that goes into it to make sure that it's operating in accordance with the laws. And because of that, board meetings, like hiring an accountant, because of that, there's a lot of fixed carrying costs that aren't going to get spread across all the owners of a captive like a group captive. So you can imagine that those costs add up, and those aren't even necessarily for the cost of risk. I had about 7 of these in my portfolio, and these were separate and distinct from my clients' traditional insurance programs, but they augmented them very nicely. These were, for a risk guy like me, these were a weapon, and I'll get to that in a second. But the use case is $100 million companies and up typically start to have the cash flow and the balance sheet to support these types of programs, because the fixed cost for operating your own be micro captive is anywhere between $60,000 and $80,000 a year. Another key difference is when you are shopping for a group captive, I think it's easy to, and although they coach you against this, you're looking at 3 lines of coverage that you know the amount you pay for in the standard market, and you're going to look to extract those out and then replace them in a captive. And even though you're not supposed to think short-term gains, it's easy to say, well, I pay $500,000 now, and I want to know what the captive is going to charge me. Yes, I have all these other benefits, but I don't really want that number to change too much going up. An 831B is not going to replace any standard lines of coverage for the most part. It can, but it's not designed to replace it. The premiums that you're going to put into your 831B captive, again, it's an insurance company that the owner owns, are going to be things that aren't necessarily covered in the standard market today, or are unfavorably covered in the standard market today. And so the premium that you pour into that is going to be additive. It's going to be an increase in the amount of money you spend. So the premium column, prepaid insurance on your financials, if you start an 831B, If you're doing it right, it's going to go up dramatically. And so you have to understand that, and you have to see the benefits that go into that. And so what really is the use case for 831Bs? What am I really going to cover? And I'm going to talk about this like I talked about it with clients. For the clients of the right size, you are constantly, and my job is to constantly talk about risks that are uncovered. The bigger you get as an organization, and depending on what industry that you're in, you're going to run into types of risks that you can't cover. Political risks. Let's think about the current war that's going on in Iran and how it's created a siphon for oil. Those kinds of things, those kinds of rapid trade risks due to war, you can't just get that covered under an insurance policy. Some of these very obscure types of coverages, things that, we would normally qualify as a business risk that are not having marketable products out there, you can insure in a captive, because when you own your own 831B micro captive, you really have a blank slate to write insurance for whatever you want. Now, there are some very common things, and I'll talk about those in a second, where they're very obvious and they're almost included in every 831B. But for the right kinds of buyers who are thinking about their risk and thinking about things that they scare them about their business, that me as a broker don't have a easily identifiable insurance product to sell them, or the premiums don't make sense, these tools are extremely helpful. Because on the other end of your 831B, once you formulate it, you work with a captive manager who specializes in this space, and they have an actuary. So you dream up whatever risk that you have, things that you never thought you could use insurance for to give you peace of mind or to help your business. And they use an actuary to say, okay, we're going to quantify that risk and we're going to decide what kind of premium needs to go in order to cover that loss. And so you really have a blank slate. And that's where I got excited as a broker, is because my mind always said, well, how do we, take out as much risk to this business as possible? And these tools allowed you to really dream big on what you could put in there. Now, some of the stuff that was very obvious that went into every single one of the 831B micro captives that I managed were things that maybe were available, but they weren't efficient purchasing in the marketplace. A good example, sadly, in the last 10 years, large employers have had to think about workplace violence, active shooter scenarios. Likely what we saw, the insurance market responded with some marketable products off the shelf. Beasley came out with one. A lot of the London market came out with one. But if you were a very large employer, let's say you ran a chain of hotels, for example, and you had this huge exposure of an active shooter, the premium might be $250,000 for a $2 million limit. And you might be sitting there saying, gosh, that's a lot of premium. And the likelihood of that happening is so low, but I really am uncomfortable with what I keep seeing in the news going bare. This is a perfect example of where an 831B becomes very attractive, because instead of flushing 250 grand away so that you have peace of mind, you might still pay 250 grand when you formulate your 831B, but I'll talk about in a second, the premium that you're putting into, guess where it's going? It's going to that captive that you own. You own the insurance company. And when there aren't any losses, you have the opportunity to return those dividends, return the profit, just like any others, a national insurance company. Travelers is publicly traded. When they have profit, they can return it in the form of dividends. Now you own your own insurance company. So an actuary says, here's the risk. They say the premium's $200,000 for whatever this risk is. You pay it. And 3 years down the line, provided you don't have any claims that need to be paid out and you don't have any reserves, you can start returning that premium back to the ownership of the captive, which is the owner of the company. Not only that, you can return that premium at a tax preferred advantage. A lot of times the growth can be cap gains. Not only that, the premium, while it's held inside the captive, can grow tax deferred in investment accounts that are controlled by the owner of the captive. So business owners who have extra cash and a fear of risk start to see this as, it's not necessarily flushing premium down the toilet like I feel like I'm doing sometimes in like the property market when I don't have a loss. This is actually covering things that I didn't think I could cover. Not to mention, it has some favorable return on investment for the premiums that I pay. The premiums are tax deductible like any insurance premium. They go in, they sit in an investment account, they grow. If I have a claim, I have my own money to pay my liabilities out of it. We'll get to that in a second. It gets even better. But in addition to that, I can take in distributions that are authorized by my accounting team out of my captive when I don't have claims. Now I've taken something that I don't think is going to happen. I've covered it in case it does. And when it doesn't, that money's not a sunk cost. So workplace violence was something we put in there. Key man life insurance. So you have key executives. You can buy these products, but again, you don't think it's going to happen, but you have to have it maybe for a bank. You can put that in your captive. captives are limited. You can put 20 different coverages in there as long as it's approved by the actuary. However, the one thing that you're going to run into is that your policy is going to have an aggregate limit, meaning you can't write $1 million for 20 different exotic coverages and have a $20 million aggregate. So your policy is going to be limited to $3 million typically, and it can grow to 5 based upon your capital and your reserving. If you have 20 things that you think are unlikely to happen, but they are affording you some peace at night because if they did happen, they would be devastating to your business, that can go a long way. A lot of my clients, I had 3 clients in be captives when coronavirus hit and COVID happened and it shut their business down and 60% of their revenue was gone because the language 31Bs are written to the advantage of the owner of the captive, meaning they are written to not have exclusions. They are written to provide coverage. They're there to provide coverage. Those organizations all were able to take claim payments out of their captives, meaning premium went out as deductible to their insurance company. They filed a claim for loss of business interruption due to COVID, and up to the policy limit, $3 million came back to them as an insurance claim would. So they are written in a way to cover it. There is no secrets. 831B insurance are typically very short. You might have a paragraph defining a single coverage because they are meant to be used if they trigger the risk. So we used to put all kinds of stuff in there. With the $3 million cap, we would put it on the end of our liability. So if you have a $3 million cyber policy, we would say, well, wouldn't we add $3 million excess of that policy? So it's really great for excess positions. It's really great if you have large deductibles in any of your programs. Meaning if you have a property program and because the conditions in the market haven't been great, now you have $1 million deductible, you can buy that down. Again, you can buy that in the standard market, but why wouldn't you spend the money on yourself knowing that when you don't tap it, you have an opportunity to get it back? So the $3 million cap reduces the total value of any single claim in a policy year for the captive, but it doesn't reduce the breadth in which you can write insurance coverages. That just comes down to how much premium you want to deploy into your captive. One other caveat thing that is to note is that the captive that you own, your insurance company, isn't going to be AAA rated by Moody's. It's going to be financially sound. It's going to pass all the sniff tests of the IRS as long as you work with a really good partner. We never had a single client who ever even got audited, let alone did they ever have any issues. The firm we worked with didn't. But it's not going to be CNA. It's not going to be these types of companies. And in a group captive, that's the point of the fronting carrier. When you go to a group captive, you are buying insurance from the captive itself for your GL, your auto, and your work comp, but they're paying a carrier like AIG or Zurich to actually provide the piece of paper that says that you put on your certificates. Because your insurance company won't go through that process in an 831B, the byproduct is you won't be able to necessarily produce certificates that are going to be adequate. So primary coverage, things that you need to put on a certificate of insurance, are a little bit challenging and typically aren't going to be acceptable. And certainly you can't provide your 831B as the first 3 million of your umbrella if you need to get to 20 million in total, because the 17 million after that aren't going to recognize your insurance company. So you have to pick the spots. Typically, again, it's going to be coverages that you can't either financially responsibly get in the market or are not available in the market altogether. I worked with somebody back in the day, and he said literally every company in the Fortune 5,000 has one of these because they make such financial sense. So these tools for the right kind of buyer can be incredibly powerful. And for me, I loved having these as part of my tool and my tool belt when I was designing insurance programs because I now had ultimate creativity into what we covered. The limit of premium that you can put in that's actually justified, I think, is around $2.6 million annually. But I would say almost all of my customers were putting in $1 million every year. And then by the second or third year, they were able to take distributions based upon the actuarial's judgment of what kind of risk remained with the insurance company. The last thing I want to talk about is if you have a claim. The claims that I paid out of my captive clients who had 831Bs were the fastest and easiest to pay. Because the coverage is so broad and designed to trigger, there is no really any issues. Like you file a claim, takes about a day, and then distributions are made. The other part that is awesome about these captives, again, going back to the pooling of risk, you have to pool risk together in order for it to be deductible. I said that the 831B will sit in a reinsurance pool with other owners of 831Bs. Usually they'll be blind pools. You won't necessarily know who everybody else is. But when you do have a claim, because you have to have shared risk, only 50 to 60% of the amount of your claim, again, up to that $3 million cap or whatever limit you put on the policy, only 50 to 60% of that actually comes out of your funds. The rest is shared on a pro rata basis from everybody in the pool. So yes, much like a group captive for GL, work comp, and auto, you might have to chip in when someone has a really bad year. You might have to chip in when somebody has a claim that hits the pool. But again, when you have a claim, you're only going to have to use 50 to 60% of your money to pay that claim. The rest is going to be pooled from the other members. And then the last thing I'll say about these, and this is the part where I'm not an accountant, so you can't quote me on this, is that again, the premiums going out to fund up to $2.6 million in your captive are going to be deductible just like any other prepaid insurance expense. The money is going to sit in an account at the owner of the insurance company's discretion on how it gets invested, as long as it's not too wild and exotic. Somebody will look at it every now and then. It grows tax free. And then when you distribute the profits that come out of the insurance company, they're often going to be, depending on your tax structure as an organization, they're going to be distributed at a tax preferred rate that's oftentimes better than the corporate federal income tax. And so the money out is just like a premium, it grows tax free. And then the money back can be better than a distribution that would go out depending on the structure of your organization. So there's tax advantages. And there's obviously the part that excited me is a wide open space to really, really, truly be able to take a pen to a piece of paper and dream up the things that put your business at risk and then properly insure for them. That's why these types of instruments can be incredibly powerful for the right organizations.